Welcome back to the channel. Today we're going to talk about how to interpret PE ratios for stocks. So if you're a retail investor that has begun exploring the world of investing, you probably heard of the PE ratio before, and it being thrown around in valuation conversations, right? Like saying oh, Palantir is an extremely highly overvalued stock because of its high PE ratio, or a certain company may be undervalued because of its low PE ratio. So what exactly is the PE ratio and how you can use it for your your own investment analysis process, right? So the price to earnings ratio, in short, the PE ratio, is basically means just how much investors are willing to pay today for $1 of the company's earnings, right? So there is a formula for this, which is basically your market price per share divided by your earnings per share, right? It's calculated by dividing a company's current stock price by its earnings per share. And there's also another way to calculate this, right? It's basically taking the company's total market cap divided by its total net income. It's just the the formalization and the units of each per share unit, right, in the calculation. So where you can obtain all this information from. So market price per share, you can usually obtain it from either your brokerage, right, reporting the share prices, or just the most financial websites like Yahoo Finance, Google Finance, investing.com, things like that. Earnings per share, this information is also available from your financial websites, right? Or you can just use a formula to divide its the company's profit divided by the outstanding per share of the common stock, right? And it can also be calculated using the past performance, which is trailing PE, or future estimates, which is the forward PE, right? So all this information are available on most financial websites. You can even use the company's financial statements, right, itself, and then just divide it by its total net income by its earnings per share. Sorry, its number of shares outstanding to get earnings per share. Market price, you just get it from the financial websites. So an example calculation is say for example, company A's stock price is $50 per share, right? And its earnings per share is $5 per share. The PE ratio is basically just 50 divided by 5, so you get a PE ratio of 10, right? So all this information you can also get it from StockPenguins.com, right? We have a free company's financial tool for you to analyze key ratios, which the PE ratio is included, right? So all we have to do is head over to the any company that you like, right? For example, in this case, I already have Palantir Pre-Search. Go to the keys ratio segment, right? And just select your valuation matrix, which a PE ratio is included, right? You can change the type of graph, right? For example, I want to see in the bar graph format, right? Different color, right? I can play around with the color, right? And change around the quarterly or annual format, and change the number of data, right? So maximum. Yep. If I want to as well, I can even export that chart that I've generated in a PDF format, right? For you to use in your slides, your reports, things like that, right? So another view that we have, right, is the legacy view. So basically, all the charts are already preloaded for you in various formats, right? So even PE ratio, where is it? P. Yeah, price to earning ratio is already also pre-shown for you, right? So, but what's more important is as a beginner investor, you should know that there are many variants of the PE ratio. So do not get confused by them, right? So most commonly out there is the trailing PE ratio, right, which takes into account the price divided by the earnings over the last 12 months. Which uses the actual reported earnings per share. So this is the most commonly used, right? So when people mention PE ratio, it's usually trailing, right? So it's TTM, price to earnings ratio. And then there's also the forward PE ratio, which divides the current price of the stocks over the expected earnings over the next 12 months. So this uses the analyst estimates, right, which is usually more forward-looking in nature, but it 100% depends on the forecast quality. So if you're using an analyst whose forecast may historically maybe like all over the place, may not be that accurate, then you will get a forward PE ratio that's not that accurate, right? So the most common case here will be use a consensus analyst estimate of the forecast of the company's earnings towards the next 12 months, and then you divide it accordingly, right? So this is the forward PE ratio. Normalized or adjusted PE ratio, which uses the smooth or cyclical adjusted earnings, right? 5 average to remove one-off spike. So there may be instances where last quarter perhaps the company that you are keen to invest in may have they may have sold an asset, which would usually lead to a spike in terms of their revenue, or even the financial statements, right? Which is the earnings per share. We get one of anomaly spike. So to account for this, right, typically the earnings will be smoothed out, and yeah, you should take account for all these one-off effects, which may or may not, skew your investments towards a certain aspect, right? Which you do not want that. You want to use the most, normalized way the company operates, right? The Shiller Cape, the cyclically adjusted PE ratio, which takes into account the price divided by 10-year average real earnings used for long-term market valuation. So this is the ratio that Warren Buffett likes to use the most, right? Which is to take into account the long term. But I think at the end of the day, for most retail analysts, these two are the most commonly presented one that you can easily find online as well, which is the trailing and the forward PE ratios, right? Next, we move on to how to interpret the PE ratios, right? So I think PE ratios by itself may not tell you a lot of important information that you should act on, right? Because there are many things that contributes to why a PE ratio is a certain way, right? Because of the price factor included into the valuation, right? So usually the earnings per share doesn't really skew the valuation that much. It's the market price per share that will skew the PE ratio heavily. So if you look at this, how to interpret the PE ratio, number one, so always compare to peers and sector median, right? So different sectors would have different PE ratios. For example, tech and high growth companies tend to have higher PEs than your utility or REITs, right? So it's always important to compare the company's PE ratio to its sector and industry mean and historical PE range if available. This is because most investors, right, probably, like, especially today's date, a lot of them are their preference skewed towards growth, right? So a lot of these tech companies would typically have a lot more people buying, which is why their market cap is higher, and as a result, their PE ratio will naturally be higher as well, as compared to your utilities, which doesn't generate as much interest nowadays. It may have a lower PE ratio just because there's less investor demand, and as a result, less buying, and its PE ratios wouldn't be that high. So it's very important to compare apples to apples. Do not compare the PE ratio of a tech company versus a utilities company when you're deciding which is more over or undervalued. It's always prudent to compare against the industry, right? And secondly, which is nicely to second, which is to ask, is the PE ratio high because of growth or hype? So in the case of many companies back in 2021, 2022, a lot of these companies, tech companies, right, like your Stitch Fix, etc., all have very high PE ratios. But you need to ask whether is it because the underlying growth of the company is there to substantiate these valuations, or whether it's just because of hype, right? Like people just buying it because more and more people buying. There's a FOMO element to it. But eventually, when the earnings per share doesn't matches the growth that investors want, doesn't match expectations, the selling will come down very fast as well when the FOMO fades, right? Which is exactly what happens back in 2022, 2023, where there was a bear market in tech stocks, especially when interest rates started to be hiked by the Fed to fight inflation, and all these companies' valuations came back down to earth, right? So it's very important to compare the PE ratio, right? Put in context on the underlying performance of the company, right? Is there a revenue growth, right? Is there strong profitability? It's growing very steadily, or even at an increasing pace to substantiate the high PE ratio, right? Number three is you can use PEG to combine growth and valuation, right? So PEG is the PE divided by the earnings growth rate as a percentage. So, for example, if your PE is 25 and your expected EPS growth 20%, your PEG is basically just 25 divided by 20, which is 1.25. So the rule of thumb is, most case, right, the PEG ratio of 1 can indicate fair value. Less than 1, it might be cheap relative to growth. More than 1, it might be expensive. So this is actually just a rule of thumb and not gospel. Just a quick gauge for you to tell whether a company is under or overvalued relative to its growth, current growth trajectory, right? Number 4 is always adjust for one-off and cyclicality, right? So it removes extraordinary gains or losses, or use multi-year average of earnings for cyclical firms, right? For example, your commodities, your airlines, your autos, right? So for cyclical companies, a low PE at peak earnings can be misleading. You have to always normalize earnings. So in this case, you just use the Shiller Cape or the normalized adjusted PE ratio if the data is available, right? Number 5 is consider capital structure and margins, right? So two companies with the same PE ratio can have different debt levels, right? So always check debt to equity, interest coverage, margins, and return on invested capital, things like that, which are all available on StockPenguins.com's financials, right? Key ratios, things like that, right? You can just always compare them. Lastly, is to always account for other valuation ratios as well. So look at cash flow multiples, your price to book, price to sales, things like that, to make sure that you don't just cover PE ratio by itself, right? It's sometimes a lot more better to compare other valuation metrics as well, especially you have to take into consideration and context of where the company's, in which stage is the the company's age, development cycles, and is it a growing company, is it in sunset industry, things like that, right? Lastly, common pitfalls and red flags of analyzing PE ratio, right? So a very high PE ratio of credible growth brand, likely overvalued and just high because of hype. Very low PE ratio versus peers could be a value trap if earnings are in structural decline, right? Negative earnings per share, so the PE is not meaningful. You have to use other valuation metrics like your price to sales or EBITDA, or wait for earnings recovery before you can use price to earnings ratio as a analysis tool, right? Relying only on forward PE based on optimistic analyst estimates. So like I mentioned earlier, it's always best to use a consensus estimate, right, to take into account like over optimistic and also overly pessimistic analysts in their forecast, right? Ignoring buybacks. So buybacks can reduce the number of shares and can inflate EPS, right? So always look into other financials to see whether your there's any financial engineering involved that makes your PE overly high, right? So for example, if a company conducts a lot of buybacks, its total number of shares would naturally drop. And if you remember the formula above, price to earnings ratio is the market price divided price share divided earnings per share. So if your per share number is down, right, naturally you will get a more attractive PE ratio from the formula. So that's all for today. Always take into account sectors and industry medians when you're comparing PE ratios, right? Take into account the company's growth stage, right? And also the underlying fundamentals of the companies. And if possible, use other valuation metrics as well in the analysis. Thank you.